So welcome to our all cohort learning opportunity. This is our first of several. We've been talking with our provider advisory group over the last week or so, but we're really happy to welcome some members from the provider advisory group as well as our state and system cohort members to today's webinar. Once again, thanks to the Kresge Foundation for supporting this work. We're really excited to be talking about funding and Pay for Success projects, so we'll get into it right now. All right, so really the purpose of today's time together is to begin to understand monetary sources in Pay for Success projects and how finances affect project development. And we'll do that by sharing some examples from previously launched Pay for Success projects as a way to illustrate ways that financing may flow. And at the end of today's webinar, we'll spend a little bit of time previewing our term sheet tool as one of the tools that we've discussed as necessary for building toward Pay for Success projects. And then when we share the webinar, we'll include the term sheet tool in that toward the end of this week. So we'll be able to go through that together as well. Here's just a quick snapshot of how we'll spend our time together today. As you can see, there's quite a bit of time toward the end to be able to close out and answer any questions that you may have. Our chat box is going to stay open if you want to spend some time crafting a question as it comes to you during our presentation, but we'll come back to it at the end of today's conversation. And just a reminder, we are being recorded, so you'll be able to share this with other colleagues or use it for reference afterwards. Okay, great. So we're so excited to be working across this learning community of states and systems and institutions of public higher ed, as well as our college access and success providers, to really be considering Pay for Success's application in higher ed. And so while the four state and system sites in our cohort have been on this journey for a bit longer, we're really happy to be discussing the application of Pay for Success tools and resources as states and systems get closer to developing their own initiatives to work more systematically as a way to fund wraparound student support services that are improving student outcomes to and through college. And that really speaks to the providers around this map and the work that you do on a day-to-day basis to help improve those outcomes. So we're really appreciative of this collaborative learning community and really excited for what's ahead. So because the state systems and states have been with us a bit longer, I did just want to take a minute to share our two primary frameworks that we've been using to consider Pay for Success feasibility. This first is our hypothesis slide, which I think everyone has seen at various points of this journey, but really when third sector set out to engage states and systems, we approached it with a draft vision that was informed by some of the feasibility work that we did with UAspire, as well as other conversations we've been having in the field. And over the last several months, incrementally, our state and system cohort sites have been engaged in a series of exercises and stakeholder conversations to help customize this project vision for their context as they think about how they're building toward a project that the sites are developing. So this is one tool that we've been using. And the second, just for reference, is our feasibility components framework, which really have been a series of exercises and conversations and digging into some deep questions to explore how Pay for Success could be applied to the state and systems that we've been working with. And so we've been using this as a way to better understand a specific student population of focus, to identify outcomes disparities by looking at data, and by conducting some preliminary root cause analyses so that we can better understand what kinds of services may move the needle on some target outcomes. So this has been our journey to date, and we're really excited now to be taking these lessons and applying them to some Pay for Success tools, which of course include our economic model, term sheet, and procurement process. So let's get into the meat of why we're all here today. As we've shared, with those on this webinar group before, we formed this cohort of states and public systems of higher education, college access and success providers, and funders, because we know that there's interest in exploring Pay for Success as one way to fund those student support services that are improving specific outcomes, matriculation, persistence, and grad outcomes for underserved students. And so last week we hosted an Introduction to Pay for Success webinar to our provider advisory group, but I will just spend a minute today reviewing some of the information to help guide why we're all here, which is to say that Pay for Success projects, really are about measurably improving the lives of people in need by using an innovative contracting model where government or another entity pays for social programs in whole or in part when outcomes are achieved by a service provider that they partner with. A critical component in these Pay for Success contracts is really tracking the effectiveness of a program over time to ensure that funding is being directed towards the programs that work well. So whereas traditional government fee-for-service contracts may require, may fund a service delivery for a specific population as well, Pay for Success really requires a payer to pledge to pay for outcomes for the population receiving services. And so this slide, as I talk through it, really just shows some of the primary stakeholders that we've seen in Pay for Success projects. And I've labeled them with language that we've been using throughout the cohort experience so far, which is the systems level payer, the service provider, private funders, and evaluators, all that collaborate together to really be able to design these projects and move the needle for a population that has been underserved. So in early or feasibility stages of developing a Pay for Success project, stakeholders are considering and responding to specific Pay for Success tools as a way to help guide how their projects come together. So as I shared on an earlier slide, some of this understanding is understanding Pay for Success feasibility in a given area, may involve what are some of the enabling or limiting factors for building a project. On that framework slide, there were a series of questions that sites are answering, and so that's helping to inform Pay for Success of feasibility in a given area. But stakeholders, they're taking positions and they're making decisions that are influencing how a project is developing. And so these factors are shaping two of the primary tools that we've started to talk about across the cohort. One is our economic model, and two is our term sheet. And so today, as we talk about funding, it may be really obvious how funding decisions are informing project economics. But at the end of today's presentation, we're also going to talk about how financing decisions inform that term sheet tool, or the business document, which is setting the terms of the parties' agreement in a Pay for Success project. So for our state and system cohort sites, this cycle, this continuous feedback loop may look familiar. We talked about it in Indianapolis. And for those who may be joining us for the first time or just seeing this for the first time, this is a cycle that we've introduced where a continuous feedback loop is created, not only among the stakeholders involved in the project, but in the way that these projects come together. Okay, so we've all seen this diagram on our Pay for Success 101 webinar, or if you're a state or system across the length of this project. But this is our illustrative Pay for Success in higher ed diagram. And state and system cohort sites have been considering how this reflects real life scenarios with their community's context. But for the sake of presenting today, we'll come back to this basic framework as a way to better understand how economics and financing decisions influence Pay for Success projects. So where there are dollar signs, that's where there's an obvious exchange of resources. But really today we're going to focus on the upper two boxes. So the private funders and the systems level payer and the relationship that happens between those two main stakeholder groups. So in Pay for Success projects, there are sources, there are the monetary inflows, and uses, the monetary outflows of resources. And in Pay for Success projects, sources can be really categorized in two buckets. One is really that upfront money from private funders that is generating the working capital that's necessary to design and operate the project. In our simple model, this can be loans or grants from private funders. And the other bucket is the outcomes money that's typically made by a government agency or a systems level payer. Today, we're going to focus on sources of outcomes payments. And in just a bit, we'll share some examples from other issue areas where we'll talk through not only the source of the funding, but just talk through some analogous systems level payers and other projects and some of the decisions they made to make those outcomes payments. Before we get into those examples that we'll talk through, and I'm going to be joined by my colleague here at Third Sector, John Grossman, we'll quickly just review some of the four sources and ways that we've categorized them as sources for outcomes payments. And so in this box or diagram here, we have these four buckets. One being funding coming from special legislative appropriations, two being funding coming from operating budgets, three being funding coming from a guarantee, and four funding from an opportunistic source, which we'll be sure to explain what we mean by that and talk a little bit about the project where we applied that lens of thinking. Additionally, and it may be really much more potentially relevant, but as Pay for Success as a model for contracting has been embraced by more and more jurisdictions across the country and increasingly so by our federal government, I do have a footnote here at the bottom which starts to talk to potentially that other source of where outcomes payments can be made. So the Social Impact Partnerships for Pay for Results Act, or more simply known as CIPRA, and or other federal legislation. These types of social impact policy may be sources where federal resources can provide a source for outcomes payments to be made as well. Great. So let's get into some examples because we know that these always come to life much better when you've got some real context behind them. So we're going to review 4 Pay for Success projects across other issue areas as a way to illustrate some of the ways that communities have considered sources of outcomes payments and some of the decisions that help them use a particular source. So I'm going to pass it off to my colleague, John, to tell us a little bit more about the Massachusetts Juvenile Justice Initiative, which I know we've used many times throughout the cohort as an example.
Thanks, Sarah. So the Massachusetts Juvenile Justice Project, which we often shorthand as MassJJ, or more commonly is the ROCA project, because ROCA, ROCA, is the provider in this case, was launched now in the, almost 7 years ago, or 6 years ago. We began negotiations in the summer of 2012, so it was an early Pay for Success project. And before the time that we launched negotiation, the Massachusetts governor went to the legislature, and together they crafted special legislation that said that the Commonwealth of Massachusetts would create a fund called the Social Innovation Financing Trust Fund. And that fund would have the ability to fund up to $50 million, $50 million in outcomes payments or success payments for Pay for Success projects if those projects met certain criteria as certified by what in Massachusetts is called the Secretary of Administration and Finance, so the money guy. And those criteria were that there was a rigorous evaluation of the outcomes in question, and that taken as a whole, the project, or if you achieve the outcomes, that it could lead to savings of some sort for the Commonwealth of Massachusetts. That legislation didn't have funding attached to it. It just created the sinking fund and the secretary's ability to bind the state to these contingent contracts, to these pay for success contracts where you promise in year one, depending on the outcomes of a project that will occur between years one and, for example, 3, to pay certain money in year 4. And so, and it also said that in addition to that, the legislature would, the secretary would report annually to the legislature about how much of that $50 million was being incurred. In other words, what were the successes that were happening during the course of that year that could lead to success payments? And the legislature would make an appropriation. In order to sort of provide belt and suspenders, the legislation went on to say that commitments made by the state, made by the secretary on behalf of the Commonwealth for pay for success contracts would be backed by the full faith and credit of the Commonwealth of Massachusetts. So it would have the equivalent of a general obligation bond. So over the past 8 years, the legislature has made appropriations into that fund, and the fund has made payouts on a number of projects. The Commonwealth has 4 or maybe 5 projects that under this legislation. And so they've committed up to that $50 million in success payments. I think a couple things to note about this. One, this was really early days. So the Commonwealth sort of went further than anybody has since then in assuring upfront funders that they would get their money back. And by that, I mean, they said both, we'll enter into a contract with you, we will create a sinking fund, and we will promise that anything under, any obligations under these contracts would be backed by the full faith and credit of the Commonwealth. Nobody that I'm aware of since then has backed a pay for success contract with the full faith and credit of the jurisdiction. And I don't think we'd recommend that to anybody. It is fairly typical practice, though, or not uncommon, to have some sort of sinking fund so that as the project goes on, the legislature and the executive are putting aside money to pay outcomes payments at the end of the project. And that is sometimes required by funders, by upfront funders, and sometimes not. It gives them assurance that they'll get paid at the end of the project, but it also means that the executive won't be going to the legislature at the end of a project looking for payments to cover, 5 years of services so that it can be spread out over multiple budget cycles. So that is the Massachusetts project, and I'm going to hand it back to Sarah, I think, to talk about the Cuyahoga project.
Yeah, sounds good. Thanks, John. So a bit of background, and I think definitely a good one or good example to follow, the Massachusetts example, and that was really, Commonwealth, and as John mentioned, just that full faith and credit backing. This is definitely a different approach. So a little bit of background just on the project quickly. Cuyahoga County Partnering for Family Success program it's the nation's first county level pay for success project, and its ultimate goal was really to reconnect foster children with caregivers and in safe and affordable housing. And so, part of the impetus for this project is that homeless families with children were placed in out-of-home foster care, and it presented a really unique challenge for the county, in which serving these families that there wasn't a previously integrated way that allowed for the idea of families who were experiencing homelessness and involvement in the child welfare system. And so the result of that was that children with homeless caregivers really were spending considerably longer time in out-of-home foster care. And this is really how partners came together, and really what helped structure then the desire to be able to fund the kind of Pay for Success initiative. the interconnected nature and the opportunity for Health and Human Services to really seek source of outcomes payments came by identifying that problem and then being able to figure out ways that they could, support the fundraising for this, and did so as part of the regular budgeting process. And so in Ohio, and this is in similar, for many other jurisdictions as well, each agency was presenting a budget that went to the county exec for approval, and then the county executive would present their budget to council. And in this case, council approved the $5 million in funding for the Partnering for Family Success program. And so I think what this helps bring up is a couple really unique opportunities for the stakeholders in this project. One was, first finding the money. So, they were able to do so through a typical operating budget process and using those procedures. And then, building from what John started to talk to, the second was finding a way to hold the money. And so in Cuyahoga, they were similarly able to use a sinking fund for the funds to sit in. They needed to determine a way for the funding to be secured and held in order to make payments over a multi-year contract. We're able to look at a payment pool structure so that they were, using funds as they needed them, and there wasn't funding just sitting in this fund waiting to be used, but that there was, a process in place, and really leaning on the operating budget processes and procedures and able to do that. I think a couple important takeaways, just as this may be one that's considered, is for a systems level payer, using this budgeting process as a way to fund their project may meet agency goals and missions in a way that doesn't create a brand new funding process. It was a way for agencies to say, here's a need, we can create something and really act on, and mission on that. And there's a working process and procedure in place in order to be able to raise the source of outcomes payments necessary. And I think another important takeaway to mention though is this approach is super dependent on the timing of a budgeting cycle and really the politics of that cycle. And when there may be a list of things to be funded that goes up to a county exec for approval, there's definitely some work to be able to make sure that the project, if stated as meeting agency goals or mission, is one that there would be some success in. So that's a little bit on the Cuyahoga example. And for the last two, I'm going to turn it back over to John to talk to us about two other projects that third sector has worked on.
Great, thank you, Sarah. So the next project I'm going to talk about is the Illinois Dually Involved Youth project. And this project faced some special challenges, most particularly that Illinois' credit rating is probably the worst, or at the time was the worst, and is probably remains the worst or second worst of any state in the country. And that there was significant turnover with the cabinet secretary tasked with the project, with various people leaving under different and under less than optimal circumstances. So those two things together, plus some legislative or some statutory restrictions in Illinois, meant that a typical pay for success structure wasn't going to work. That funders, upfront funders or lenders to the project weren't going to lend money and be comfortable that that the state would ultimately pay it back at the end of this justice project when we understood outcomes, so 3 or 4 or 5 years down the line. Additionally, even within the state, they weren't confident because of their budgetary situation that if they created a sinking fund, so they put aside money in year 1 and in year 2 and in year 3 to possibly pay outcomes in year 4 or 5, that money wouldn't get rated, that it would just sit there waiting to be paid for outcomes. So those were serious challenges. And I'm talking about this, or we're talking about this, not necessarily because it matches the circumstances that any of you might find in a project that you entered into, but because it goes to how we can work through and around constraints, what we believed were constraints to funding the project. And so what we did, what we agreed to do in Illinois, is we developed something called a social impact guarantee. And the social impact guarantee works almost as the inverse of the normal pay for success project. So in a normal pay for success project, there is upfront money put in by funders, by impact investors, impact lenders, and philanthropic sources of capital. And that money is used to pay for service delivery, as well as other project costs, evaluation, and the like. And then if the project is successful, if the provider or providers hit their outcomes, the government, or what we're calling in this context, the systems level payer, pays that back to the project. And funders get some or all of their money back with interest, depending on the capital structure of the project. So you have upfront money from private sources and outcomes payments or success payments from public sources. In Illinois, instead, we flipped that, as I said. And so what would happen is Illinois would pay for services as they do in the ordinary course. So they pay for services, in this case, for services designed to keep dually involved youth. In other words, those youth who are both in the social service system, foster care, or social services, as well as in the juvenile justice system, out of the justice system. So it would pay for those services in the ordinary course, by person, by program. And if the metrics were hit, if success payments were made, nothing further would happen. The government would pay, and they would pay for successful services. If, however, the success metrics were not hit, the social impact guarantee would come into play, and the funder dollars would be used to reimburse the state of Illinois. So think of it like an insurance program. Illinois basically was buying insurance, so shifting the risk. What if this program doesn't work? Just like any pay for success program does, but they were putting up the money up front, and then they'd be reimbursed if it didn't succeed. This idea met a lot of the challenges that we had in that project. It also can be more financially efficient for reasons we can go into if it makes sense, or we can individually later on if it makes sense for any of you. The downside of this is, honestly, from a funder point of view, there was just an optics issue. They like the idea, and this is from the upfront funder point of view, they like the idea of paying for services and getting their money back when the services succeed. So in other words, paying to keep young people out of jail and getting some financial return when that project succeeds. That sounds good. You're paying for success, as the title goes. The problem with this structure, even though the cash flows would be the same or potentially better for the funders, so even though they'd put up the same money, or maybe not ever have to put up their money so that they could continue earning interest on it and never actually make any payments if the project succeeded, they didn't like the idea that they would only pay their money, only get a bill if the success metrics weren't hit. And there was a sense of where we're paying for failure, not for success. And as I said, this was a psychological issue, not a financial issue, because of course, in the normal pay for success model, you put up your money and you get it back if the project succeeds, and you don't get it back if the project does not succeed. In this case, you don't get your money back, or you lose your money if the project does not succeed, but it just felt different for funders. So it was taking some selling on our part, on the provider's part, on the state's part, to get funders aligned. And then the political wind shifted again in Illinois, and it just didn't make sense to work on the project through a third secretary leading it. There was just a loss of faith and face on the part of all parties. And so unfortunately, we haven't tested this model in the market, but we put it out there both as less as a specific example, although it does have value as that, but more as an example of how you can get together and be creative and use different financing models to work through problems faced by a jurisdiction or by a specific project. Next slide, Sarah. Thank you. Last project we're going to talk about is the Salt Lake County PFS initiative. And this was another county initiative. It was actually the first time until Colorado did it early at the very beginning of this year, where a jurisdiction launched more than one project at the same time and raised money simultaneously, in this case for 2 projects. There were originally 3 and one fell by the wayside along the way. But it launched 2 projects, one to address homelessness, and the other a criminal justice project that was similar in many ways to the ROCA project, different in the intervention, but similar in the sense that the goal was to reduce costs to the criminal justice system, and well, secondarily to reduce costs to the criminal justice system, primarily to reduce the cycle of incarceration among returning citizens. And the homelessness project was to provide rapid rehousing to people at risk of becoming chronically homeless. In this case, the funding, and we call it opportunistic, the county was trying to figure out the best way to fund the outcomes payments here. And they had several years previously launched a bond or sold a bond into the market to fund the building of a new county jail. This was a bond issue that was approved by referendum, as it has to be in Salt Lake County, as well as by the legislature. So it was approved by popular vote as well as by the legislature. They had been able to pay off that bond earlier than expected because of good revenues and good fiscal management on the part of the county. But the exact number of years isn't the point. So they had gotten approval to have a levy to pay off this bond over, say, a 10-year period, and they paid it off after 7 years. So what they did was they went to the legislature and to the public, this was approved in a referendum, and said, you're expecting to pay X cents in addition on each dollar of your property tax for the next 3 years, because we've completed 7 out of 10 years on the bond. We would like to continue that, but instead of building a new facility, we're going to invest that money in reducing the need for additional criminal justice facilities down the line, specifically by taking that money and putting it into a sinking fund that will be used for outcomes payments for these 2 pay-for-success projects. And the referendum was approved without really any opposition, as it was by the county council, by the legislature. This one is interesting primarily, and this is why we call it funding from opportunistic sources.
Hi, Justin.
Because it's not a situation that's likely to be reproduced. I mean, it's lovely if it is replicated in another jurisdiction. But because the county, the mayor and the head of Pay for Success and the CFO for the county were sort of looking around for figuring out how to fund this, and were creative and grabbed this opportunity that presented themselves to fund the Pay for Success project in partnership with a sinking fund. And so we wanted to highlight it because it highlights not the creative financial work that was done sort of led by us or as the project manager in Illinois, but instead this was a government or systems level payer forward creative way to fund outcomes payments.
Great. Well, you know, as we finish out presenting some of the information in the deck, as I mentioned earlier, we will definitely save question time for the end, so won't go right up to the hour. I assume that as we introduced each of these 4 examples, that folks on the line will have questions. So if it's helpful, as it's fresh in your mind now, to type it into a chat box, that's totally your prerogative, but we'll be sure to, you know, open up the line and answer any questions toward the end. But as I started, you know, talking about funding decisions informing components of Pay for Success projects, and those decisions really being captured in tools, I did want to just bring back our term sheet tool as it's the basis for multi-stakeholder agreements. And what you probably started to hear in the capture of all 4 of those examples is just the intensity of community engagement and stakeholder engagement that took place as a way to create these projects and get them, in many cases, to launch. And so for state and system folks on the line, we've reviewed a little of this during our time at the convening in September, but for the provider advisory group, this will be new information and will help you navigate what we'll share as a term sheet template toward the end of this week. But a term sheet is really a document that helps set the terms of how different stakeholders in a project agree to those terms and then negotiate project development. And so term sheets, you know, as that business document, then help lawyers draft the legal agreements that help govern the project. And so in many Pay for Success projects, there are around 10 or so different legal agreements that are all drawn up as a response to the term sheet, which is an easier, more digestible way of understanding some of the terms of the project. Term sheets also inform how funding drivers from our economic model may be changed or modified to inform the project negotiation. So as where economic models can be complex spreadsheets, term sheets typically are an easier way of presenting some of that project information, and as it changes or as it gets modified by stakeholder voice is then fed back into that economic model tool to adjust for those choices. So this, you know, in this talking hopefully reinforces some of that continuous loop that we saw earlier, that each inform one another and become really interconnected. But the term sheet definitely is a tool that as we think about project development can become one that stakeholders lean to as a way to really start to break down the more complex nuances of how projects come together. So what we'll share with the cohort and the provider advisory group is a term sheet template, which will be something that helps stakeholders in the initiative begin to document the relevant positions and decisions that are being made as project components develop. And so the next few slides, I'll just highlight 4 of what we're considering some of the more major sections of our term sheet template, so that you can have more familiarity with navigating your way through the tool and understanding some of the decisions that we've helped make in setting up this tool for the community. So the first is really defining project participants, and that's really, you know, basically who is involved in the project. And that's both official project stakeholders to other partners who may be informing and helping shape the work, service providers for whom they're delivering the supports to students. And you'll see in this section, it really breaks down based on some language we've started to talk about in the cohort. But I'll say, you know, on this first one and for all 4, really it's customizable based on the context of the community and who you're engaging, both in the project and how the project is designed. And that brings us to the second, which is determining a project structure. So eventually, you know, that illustrative model that we've been sharing will transform to become more of a project structure that talks to the unique context of where a project is being built. So the section in the term sheet typically helps stakeholders understand their role and how mechanics of a project will actually function.
You should go out that way because the Dogs are out back.
I know, I can just
Right.
put them inside.
You jump.
All right, number 3 here is
And that's all.
really reflecting project hypotheses as decisions.
It's just one step away from being in.
If someone could mute their line, that would be great.
Why do you like my socks so much?
Great. So reflecting project hypotheses as decisions. So up to this point,
The other snow pants are in my room on the floor in my bedroom.
We cleaned up our basement, right?
So up until this point, we have been talking about considering feasibility components, and we've been exploring how different choices inform our project hypotheses. So if you think back to that slide I kicked us off with, that's an initial vision that ultimately is being shaped by stakeholders and the kinds of perspectives that are shared on the ground. And so while hypotheses or our draft project vision can be a really critical starting point, eventually decisions made or assumptions that we arrive at in that hypothesis become inputs for which we're anchoring decisions in our term sheet and become really that jumping off point for how we start to negotiate the terms of the project. And finally, this 4th one, documenting project funding estimates. This brings us back to funding and funding sources and why we're all here today, because this section in a term sheet really helps expand upon our, estimates for funding sources and uses. It includes, who might provide that upfront working capital, who would make outcomes payments and from which source or sources, and how funding will be used to operate the project. So we talked through a couple sources of outcomes payments on this webinar today to give a better flavor of how other jurisdictions have started to do that, and ultimately how this is done in your projects will really depend on the context of your community. But as teams have an opportunity to review this term sheet template, our goal is that you start to have not only an understanding of the tool and what it's used for, but how it starts to help stakeholders build toward pilot projects and project initiatives. So we have been talking a lot. I really appreciate you bearing with us as we put a whole bunch of information out there. We'd love to open up for question and answer and just see where you've got questions on the examples we shared today or anything else we talked about. And I'm happy to go into some other content if that's helpful, but want to pause and just open up for questions. Perhaps I'll go back to our examples as well, just to put those fresh.
Hey, Sarah. This is Lorenzo with ASU.
Hi, Lorenzo.
Hey. Quick question for you, and this is a perfect slide to bring up. On the 3rd example that you guys were sharing with the funding from guarantee. So the way that I understood it, and please correct me if I'm wrong, but the way that I understood it is essentially the upfront payer is taken out of the mix of that example, right? So essentially the service level payer becomes that upfront payer.
Is that correct?
Yeah. Sarah, do you want me to?
Yeah, I love that, John. Thanks.
Yeah. So Lorenzo, that's basically it. I mean, think about it that it's just like an ordinary contract where the service level payer is hiring an outside vendor to do something. I mean, in this case, to provide services that will enhance matriculation persistence and or success. And they're going to pay for that just like they would any vendor contract. But in this case, there's a money back guarantee, right? So in this case, if the project doesn't work, the systems level payer gets their money back. And that's where the upfront funder is providing that money back guarantee.
Okay.
Does that make sense?
Yeah, that's helpful.
Thank you.
Great. John, I might tap into you for answering or help answering this question as well, but one of the attendees asks, which of the funding source outcome payments examples do you feel has made the most impact with the Pay for Success model?
I think it's been something of a cross between 1 and 2. It's a good question. In most jurisdictions, in most jurisdictions, it's been more of 1. In other words, more a special authorization of funding to pay for Success, with the hope that improved efficiency and improved programming warrant that expenditure of money. In some cases, it's been able to happen through the operating budget, so more like Cuyahoga. But as I said, in most cases, it's been, let's find some new money or some otherwise unexpended money to make outcomes payments.
John, maybe you can just further comment on that first example in terms of the order of operations of kind of first setting up the ability to have an outcomes fund and then making the specific appropriation for the specific projects. And, you know, if you've seen that it typically needs to happen in that 2-part process, or if there are any kind of variations on that that might be helpful for our state and system partners to think about if they're planning to go to their legislatures.
Yep. I think in most cases, and I haven't done I haven't done a study of that question, but I think in most cases what's happened is there's been a fund created, or if not a fund, the authority has been created in some way to enter into contingent contracts. The trick here is that in almost every jurisdiction, there's a limit on the legislature's ability to bind future legislatures. So in most jurisdictions, you can't here in 2019 say that the legislature sitting in 2022, when this project is over, will have to authorize money to pay for an outcomes contract. And so the trick is, do you A, create some kind of sinking fund where we're going to put money in over time to pay down the line? Or B, do you just say, we're going to do these contracts, and funders, just like many people who do business with the state, county, or university system, whatever the systems level payer is, are going to have to trust in our commercial good faith to make payments down the line. And that's really what's happened in Cuyahoga. Is Cuyahoga said, look, we do business with folks in lots of places where the contract goes from one year to the next, and we all have an understanding that that's an expectation that that's going to occur, though we can't be bound across fiscal years. So you have to set up that fund or that authority or that vision first, and then the appropriations follow. Sometimes that's really done in one fell swoop. Other times it's spread out through separate legislative actions, or even across multiple fiscal years. Does that answer, HK? Maybe that was more than you wanted.
I think that's helpful.
for those on the line, as definitely feel free to chime in. I'm happy to go to kind of how we've offered to, yep, go for it if there's a question.
Hello, can you hear me? This is Cynthia.
Hi,
Okay.
Cynthia.
Hi. I'm really interested in learning more about the funding from Guarantee, but I'm also a little bit confused. And I know our whole model may be a little bit different, but I mean, isn't there just a guarantee? Isn't that also just your outcome in all of the other instances that are provided here in terms of like from the operating budget or the appropriation? Our outcome is basically saying that we're going to pay back for this, and it seems like that's also part of what the guarantee is. I'm maybe speaking, working through my thoughts and speaking them instead of making sure I have a question there, but I guess I'm just a little bit confused about the difference between the guarantee and how that is different from the outcomes in the other examples.
Cynthia, it's a really reasonable question, and because it's a really just a question of timing, right? So in both cases, the systems level payer pay only permanently parts with their money if outcomes are achieved. And in both cases, the upfront funder, whether it's philanthropy or an impact lender, only gets their money back with interest if the project succeeds, and parts with their money if the project doesn't. So in both cases, the risk of the project not succeeding is financially owned by the funder, and the systems level payer only pays if outcomes are achieved. So you're 100% right that both models or the two models are the same in that sense. It's just a timing question. So in the classic PFS, if you want, I don't know if you can call anything classic that's been around for as little time as this, and we're only about 20 of them have been done in the world, or in the US rather. But the classic version of PFS is the philanthropies and the outcome lenders put the money up front. You spend that money down during the life of the project. If it succeeds, government pays back, or the systems level payer pays back. If it doesn't, systems level payer keeps their money. The upfront funders are out. In the social impact guarantee, we just flip-flop the timing. So government systems level payer puts up the money up front. If the project succeeds, they pay for it. That's, they're paying for success. If the project does not succeed, the outcome funders and the philanthropy give them their money back. So it's just a timing question. Does that make sense?
Yes, thank you.
You're welcome. And I say it's just a timing question. In its essence, it's a timing question. If it was done in a completely rational way, and I don't know that I think it's the case that in government and in the social sector, we rarely behave in a purely economically rational way. And there are lots of good reasons for that. But if we did do it in a purely rational way, there would be some financial benefits to the funders in the social impact guarantee. And it should be easier for the systems level payer, because you're not doing anything clever or different with your money. You're just paying out contracts the way you always pay out contracts. But in this case, if you don't succeed, you get if the vendor doesn't succeed, you get the windfall of getting your money back and trying something else.
Great, I love these questions that have been anchored in the examples that we offered. I'm wondering if there is any other clarification. I know we're coming up on the hour, that we can offer related to sources of outcomes payments, pay for success project financing, or generally questions that maybe providers on the line have as this relates to them. We will work on kind of communicating or articulating some of the further explanation on how these are either similar or different from one another, and follow up in terms of our examples with that information. It came as a suggestion. I think that's a good one. I think if there are no other major questions, I know I'm doing a little bit of bouncing around here, but really just wanting to close and offer some next steps. As I started off by saying, this was a webinar that really is one of the first of our whole learning community. So that's our state and system cohort partners, but also our provider advisory group. And we're really excited to dig in further with this whole team of folks on a few future learning opportunities, which are here on the screen in green. As a reminder, this webinar is recorded, so we'll be able to share it on the website and be able to, that way you can send it, come back to it if that's helpful, or share it with other colleagues. Our next all cohort learning opportunity is scheduled for Wednesday the 13th from 2 to 3 Eastern Standard Time. We're going to be joined by MDRC. They'll talk a little bit more about services with an evidence base, and we'll be able to share how that may have implications for procurement in a pay for success contract. But otherwise, we're nearly at November and coming up to the end of our time together as a full cohort. So if you have questions coming out of this webinar, feel free to send them to me or team, and we'll follow up with these materials and some of those other resources as well. Thanks again for joining us today. Glad we were able to have this time, and we will be in touch soon.